Hi, welcome back. Amrin Agarwal, financial educator and director at FinSafe India, joins in now to talk about equal weighted funds. Equal weighted funds, of course, a category of something called smart beta funds that have now seemed to be becoming all the rage. Hi, Amrin, isn't that the case? What exactly are equal weighted index funds?
Hi, Samara. Yes, a lot of interest in equal weighted funds all of a sudden from the last couple of months. So these are basically passive funds with a small active element wherein wherein whatever index you replicate, instead of replicating it on a market weighted basis, you allocate the same percentage of weight into each of the stocks. So, for example, if you're replicating Nifty 50, you're going to have a 2% allocation into each of the stocks. And what this means is that companies that have a higher allocation are going to get a lesser allocation, and companies that have a lower allocation in the index are going to have a higher weightage in this particular fund. The funds are rebalanced on a quarterly basis, and currently, some of the equal weighted funds that are available are like Nifty 50 or Nifty 100 equal weighted fund.
Okay, so basically, like saying that you love all your kids equally, right? Okay, but Rin, how would an equal weighted fund compare with the larger indices, like say the index fund of a Nifty 50, which is right now weighted according to market cap. So you'll have companies like HDFC Bank, Reliance, etc., which are close to 10% almost weighted, and then you have smaller companies which would be 1%, half a percent, etc. How would the performance of both compare? I mean, what would be the pros and cons?
So when you look at the pros of the equal weighted fund, I think the pros is really the lesser concentration, right? As you mentioned, a stock like Reliance, for example, has 11% concentration in the Nifty 50, but in the equal weighted fund, it will have only 2%. And similarly for various sectors, right? So for example, financial services is about 37% in Nifty 50, but in the case of an equal weighted fund, it will be about 22%. So I think, the main thing is that you're getting lesser concentration, you're getting better diversification. But at the same time, these funds are also higher cost. So even when you look at the direct plans, a direct plan on a Nifty 50 fund costs you about zero point 0.2 and lesser, of course. But the expense ratio on the direct plan on these funds that we are seeing is about zero point 0.4 to zero point 0.6. So certainly the expense ratios are quite high compared to the plain vanilla Nifty 50 funds.
But Mrin, why would an investor then consider these funds? I mean, are they superior in terms of returns?
Not really, because, or I would say, actually, I would qualify that to say that there's no conclusive trend. So typically, these funds tend to perform better when you have a broad-based market rally or broad-based market movement. Certainly, when you have polarized markets or you have only a couple of stocks performing, you would not find these funds doing that well. And that's when you look at the data on the performance on in different calendar years, you find that when you look back 20 years, for example, you find that maybe 12 out of 20 times or 22 times, if you look at the last 22 years, you find that sometimes the equal weighted funds have done better, and sometimes the market weighted funds have done better, and it's a pretty much equal performance, right? So there's no trend line to say that the equal weighted funds have been doing better majority of the time. It's an equal sort of a split in terms of performance between both equal weighted and market weighted. Also, when you look at the volatility and all of that as well, it's different for every time period. So there's really no conclusive trend line. I think a lot of these funds are basically there to give investors an alternate to a plain vanilla passive fund. But what is really important for you is also to check out the tracking error and the tracking difference. A lot of the funds in the category are actually very new right now, and the tracking error is yet to be seen. When you do look at the tracking difference, so the difference in performance between some of the funds that have been there for longer, it's quite a lot of difference versus the index. So, while it provides a more, if you believe that the broader index is going to give you a better return and that's why you're getting into it. But I think you have to be really mindful of the tracking differences that exist in the funds as well.
If the equal weighted strategy has not been proven to be superior to market weighted over longer terms in terms of performance, would it make sense to pay the higher expenses compared to a plain index fund? I mean, which side are you batting for?
I would actually wait and watch, because again, there's no conclusive trend line to say that these have done better. Yeah, I mean, if you do look at a CAGR basis, maybe you might find some outperformance, but I would still wait and watch. And as I said, I would wait and watch the tracking error and the tracking difference, because when I looked at some of the funds that have been there, let's say for a 3-year period, right? There are very handful of funds, and the difference is quite a bit, right? So one of the funds, for example, has given a return of 12.77%, whereas the index has given a return of about 14.5%. So there is quite a lot of difference that one is seeing. So I would wait and watch to really see how the category develops. And in any case, you have the market weighted, the plain vanilla index fund, which is very, very low cost in any case.
But Amrin, just out of curiosity, wouldn't the rebalancing in these funds be done in real time? I mean, what is it that is giving rise to this kind of tracking error and difference?
It could be a lot of factors, like it could be, the implementation time. Also, one of the other things that I saw with these funds was that the AUMs of some of the funds are like really small as well. So I think it could be and also the fact that the rebalancing, I think, is done on a quarterly basis. That also could be the reason for the difference, the tracking difference.
Okay. For a market-weighted index fund, I can imagine that, even one big stock or one heavyweight has the ability to skew the index, right, the returns. In an equal weighted, of course, that is not there. But then you're missing out on the rally which some of these heavyweights would have. So in terms of volatility, which one would you prefer?
I've seen that the volatility is not much different when you look at it at different periods of time. Both of them have kind of similar volatility, surprisingly, So that was another thing that surprised me quite a bit when I looked at the numbers.
So, Mrin, would you say that therefore a new investor, somebody who's new to investing or newer, to stay away from equal weighted index fund? I mean, for now, look at index funds and, let this category mature, so to say?
Yes, absolutely. I would certainly put it on a watch. I would certainly watch and see how it's performing over, some time before making an allocation into it.
Okay, and for those, for a savvy investor for whom an equal weighted strategy might fit into their portfolio, any of the funds or schemes that you might recommend?
Well, there are only a handful of them right now. I think there's DSP and there's HDFC. So there are very few of them right now to choose from in any case.
Okay, I take your point, Mrin. Thanks very much for joining in to talk about this equal weighted index fund. So like I said, it's one of the categories in the smart beta space, but one which probably has more potential. But that is something we can only gauge with time. For now, thanks very much for your attention. Thanks for watching. We'll wind up on MF Corner, but do stay tuned. The team of Closing Bell will join you next to take you through the last hour of trade.